Good morning, everyone, and welcome to today's virtual discussion on the new round of PPP, What You Need to Know. I'm Jennifer Sims with the Capital Region Chamber, and thank you for joining us. Thank you to the team at UHY for taking the time to provide us with updates on this new round of PPP. Before we get started, I want to share some Zoom housekeeping. For viewing this morning's program, it would be helpful if you select Speaker View from the top right of your screen. All participants are on mute, and we ask that you keep your mics muted to eliminate any background noise. We're going to start with a presentation that will cover quite a few of the questions that many of you submitted prior to today, and then we'll go directly into a Q&A session. So if you have any questions, please put them in the chat, which is located at the bottom of your screen at any point during the presentation. After today's presentation, you'll receive an email with the slides. Now it's my pleasure to introduce our presenters. Mike Poveda has almost 25 years of professional experience providing accounting, advisory, assurance services to clients in various industries. Michael is a partner in UHY's Albany office and leads UHY's client accounting advisory services practice in the Northeast. He advises clients on important issues and trends impacting businesses, including complex financial reporting matters, capital transactions, risk management, digital transformation, and performance improvement. Ali Baydoun is a lead member of the Enterprise Business Services team and has experience providing advisory, tax, and attest services for middle market clients. He supervises in manufacturing, software, and printing industries. Ali has been called on regularly to present on U.S. tax planning, post-tax reform at several firm events. He was named the top delegate of the UHY Leadership Forum held annually in Spain, recognized as an outstanding young talent displaying exceptional leadership skills among member firms. He is a past recipient of the Rising Star Award from the Arab American Professional Networks. Good morning and welcome, Michael and Ali.
Morning.
Good morning. Good morning, all. And first of all, I just want to thank you, Jennifer, Marna, and Mark, the entire team at the Capital Region Chamber for hosting this event today. Ali and I are proud to be here with you on this, obviously important subject matter and area that's on top of everyone's mind. So on behalf of UHY, again, thank you for hosting us today, and we're looking forward to having a constructive conversation today, and I hope you all find this useful. Ali, if we can advance to the next slide. So what we plan to cover today, and again, keep in mind, things are evolving, right? We've been through the PPP program before. I think when we last met, summertime, things were evolving. And as we sit here today, there are still elements of round two that are evolving. And we'll touch on some of those pressure points. But the information in today's presentation is as of today, January 15th, and maybe subject to changes afterwards. But what we plan to cover today, so the recent legislation created a few different changes, right? Focus has been really on the PPP program, but there are some other items that we plan to cover here as well. You'll see, there's some changes to the employee retention credit, and there's a new grant program, the Shuttered Venue Operator Grant Program, we want to touch on as well, because it is important that you have your alternatives in mind as you're thinking of your next steps in which direction to go for your financing needs. We have later on in the presentation links to additional resources, that'll help you along the way to links to websites and so forth that will hopefully help you. So without further ado, let's flip to the next slide, Ali. So there are a few new programs, including the PPP program that were introduced. You can see here the funding that is available. under the Consolidated Appropriations Act. So just to start on the PPP program, that 284 billion, that's broken into two components, right? You've heard a lot around round two, right? There's the PPP2, there's a second draw program, right? That's now available. But they also made some revisions to round one. Okay, so, and we'll talk about both of those in more detail in the slides to come. But to help you navigate some of the rules and guidelines that recently came out, okay, and that's what we plan to help you with today. There were two separate interim final rulings that were issued just last week by the SBA and the Treasury. So you'll note there's one, call it the consolidated rule for the first program, which basically brings all updates, enhancements related to the first draw. Okay, so that's sort of the reference guide for those looking into PPP1. And then there's a separate ruling that talks about PPP2, right? And the changes in draw 2. So just to be clear, before we jump into some additional details, in order to be able to take a draw on the second PPP, you actually have to have a PPP, a first round of PPP, and we'll go through some of the restrictions there. But and further, you would need to not only have a PPP, but you would also have had to use all of the funds, or all of the funds underlying that loan before applying for the second program. Ali, anything you want to add?
Nope, that's pretty good.
Okay, great. So moving on to the next slide. So this just summarizes the results of PPP1. So really, the message here and what we're hearing as well, we feel like this second round is going to go pretty fast. Okay, so the total amount available, that we just saw on the previous slide was 284 billion. If you assume that the same borrowers are in round one are going to go for loans in round two, right? You can already see that there's there's quite excess demand. So even if you take off those loans, and we'll find out, round two, one of the differences is the maximum loan size is 2 million as compared to the first round, it was 10 million, right? So you take, all the loans here greater than 2 million off the table, about 100 million, you're still left with, about $420 million or $420 billion right? That if you assume, those in round one would go after. So we anticipate there to be excess demand. So really, at this point, as you're evaluating your options, the time is now to really consult, be communicative with your lenders, with your professional service providers, and be proactive. A couple timeline points as well. So the SBA platform opens today for lenders with $1 billion in assets and below. And as of right now, they plan to open the program next Tuesday for everyone. So, it's moving pretty quickly. Ali, anything else you want to add on this slide?
Yeah, I think that's the point, is that it's very critical to take, depending on who is your lender. This weekend is going to be the critical gathering of the information weekend, so that you're ready to go in for applications as soon as possible, early next week. Because to your point, Michael, this is this will likely go quick. Question is, if it does, like they did the first round, if we remember in the first round of PPP, is there going to be a second, an increase in appropriations? There's a likelihood that will happen, but that's always nothing to bet on. So.
Right. Okay, great. So let's jump into some of the updates now. So we now have the distinction high level between PPP1 and PPP2. Now let's help you understand those differences a bit better. So as I mentioned, there were some updates to round one. So the first bullet here, those who did not apply for round one now have the ability to apply. And the window, so to speak, is open through the end of March. Okay, so those who didn't apply, and there's also an opportunity for those who perhaps decided not to apply, they gave money back, or they elected not to go for the maximum amount of their loans because rules were changing. Perhaps perhaps you had some concerns around the rules as they were extremely fluid in the early going. Now you have another shot to actually increase the amount of your loan in specific situations, right? There's also, there are also some changes to the calculation of the maximum loan amount for certain entities. So for example, farmers and ranchers, partnerships, seasonal employees, which we'll get into a little bit later as well. So if you're, seasonal employer, for example, and you go back to the rules, you think there's an opportunity to increase the amount that you took in PPP1, that would be an option for you. You also see there are some other entities here that have been scoped in, 501c6 entities, which is a significant change, and that's very nice. You'll see there's certain news organizations, not on the slide, but also included now, or destination marketing organizations. So there has been a slight change in the scope of PPP1 as well. So if you're a 501c6, you have the ability to apply now. So the last two items on this slide relate to forgiveness. So if you have not received your forgiveness from the SBA yet, you still have the ability to go back and maximize that forgiveness for a couple of the rule changes. One being the expanded definition of covered expenses, which we'll spend some more, or allowable expenses, which we'll spend some time on in the slides to come. And then the other is the ability to choose the covered period, any period between 8 and 24 weeks. Ali?
Yep. So PPP2, the way we want to structure this presentation is essentially we wanted to lay out some of the key distinctions between PPP1 and PPP2, focusing more on what PPP2 is brought in as changes, or are you eligible, and how do you go about applying for that one, because that's really the topic. The assumption is most companies have received their PPP1 and now are going for PPP2. But as Michael discussed, if somebody did not receive a PPP1, now there's an updated opportunity to go back into PPP1 and get that using the updated rules and the nuances that have been introduced with that. So we'll start with eligibility. PPP1 is available for companies who had 500 or fewer employees, or companies that qualified under the definition of small business concern. This is a very key definition. It's a definition within the SBA guidelines. And essentially, that was a definition that afforded companies who had maybe more than 500 employees to actually get this loan, because this definition gives alternative ways for certain companies to actually be able to qualify. Some companies could qualify on revenue size. It's based on their NAICS codes. And some companies did not have, employee limitations. It was available for tax exempt organizations, but it was limited to 501 C3s at the time, as well as some religious organizations. And the distinction is now PPP2 came in and said, well, companies now under 300 employees are eligible for round two. So you can see it's kind of narrowing the scope of who can get that second draw. And it no longer afforded this concept of small business concern. So companies could no longer use these alternative methods that the SBA afforded the first go round on this second round. So now this is a more mechanical test of 300 and under that's gonna be eligible. We get a lot of questions about, well, how do I calculate my employee headcount at the time I go for my application? The SBA rules is given kind of a couple of alternatives. The general rule for SBA is you use the average 12 completed calendar months prior to your application date. So if I'm going for an application in January of 2021, I'm using the average employee headcount for 2020, the average employee there. And the definition of employees with the SBA is full-time, part-time. They even go into temp agencies, PEOs, leasing. All those would count, and they would count as one. You don't partial count anybody. So pretty much somebody's been on your payroll, and even they go to the extent of temp, you have to count them as one, and you get the averages per pay periods, and that becomes your average number of employees. The FAQs that were released as part of the PPP program have given kind of an alternative that seems to suggest that you can actually use the headcount based on the same calculation period that you're going for. So if you're going using your 2019 payroll to calculate your loans, you can leverage that same headcount for that period instead of using the previous 12 months. But the previous 12-month completed calendar months is the typical SBA way of calculating employee headcount. I would point out that it's on an affiliate basis. So if you have multiple companies that you control, you have to look at them all together, not just as one, to determine whether they're eligible or not. Also, the second criteria of eligibility under PPP2 that wasn't there in PPP1 is now you have to prove that you had a reduction in revenue of 25%, at least 25% in any particular quarter. And Michael's going to go into a lot more detail on gross receipts, its definition, and how this applies. So we're just going to mention it briefly here, and then we're going to go into details in some slides later on in the presentation. Couple of other items that relate to eligibility, still available for sole proprietors and independent contractors. They are emphasizing in this one that if you were not in business as of February 15th, 2020, that was there in the first round, but it wasn't as clear. Now it's a big emphasis. If you were not in business as of February 15th, 2020, you are not eligible to take these loans, and you cannot have a business that has since been permanently shut down. The point that Michael made earlier about the eligibility for PPP2 is you had to have received a PPP1 loan, and you have to prove at the very least that you have used or will use the funds by the time you get your PPP2 dispersed. So you don't have to apply for forgiveness. That's not a requirement, but you have to be able to prove that you have since exhausted your PPP1 funds before you're eligible to receive a PPP2 fund. There's some ineligible entities. There's a list of entities in the SBA code that are not eligible for assistance, like financial institutions and so forth. We have a link for those particular entities. Any entities now that are involved in political lobbying are not eligible. Entities who are associated with or owned by 20% or more by companies from the People's Republic of China are not eligible, or have a board member that is a resident of China or Hong Kong are not eligible to be the recipients of these loans. But the most important one, which we're going to cover later on, is entities who will receive the Shuttered Venue Operator Grant Program are not eligible for this. So for some clients that fit into the Shuttered Operator Grant Program, I think an analysis needs to be made to decide whether PPP2 makes most sense, or that grant program before you pull the trigger and go in for the loan. Michael, to you.
Great, thanks, Ali. Yeah, so this is an area that we've been getting a lot of questions around, gross receipts and the definition. And just to start high level here, and I know there's a lot on this slide. You will have these slides, so I'm not going to read through this word for word. But so this requirement is specific to PPP2, so the second draw. If for those who are going back, maybe didn't apply for the first round, this does not apply to you. This requirement is only in the second draw. You know, and the point being is that it's, you know, the SBA and the Treasury want those second, you know, in the second round really to demonstrate additional need here. So there's a requirement to show that you've had a 25% reduction in your gross receipts from the comparable quarter in the prior year. Calendar quarter is how we're interpreting that to be. So, for example, if you had, you know, operation for the full year in 2019, right? You would need to do a comparison, you know, and there's a couple different options available to you, but for each quarter, let's say, you know, Q1 2020 to Q1 2019, Q2 2020, Q2 2019, and so forth. And if in any of those quarters, your gross receipts declined by more than 25%, then you qualify, okay? There's also an ability or an election to do that on an annual basis. So you don't necessarily have to go quarter to quarter. You could actually look for the full year, 2020 to 2019. And again, the presumption is, you know, if you meet the 25% threshold for the entire year, then you would meet it for, you know, one of the individual quarters. So it's kind of like a practical expedient. There are specific rules as well if you didn't have full operations in 2019, and those are laid out in actually the loan application. There are two new loan applications, one for, you know, draw one for draw two. So you'll see these rules laid out in the draw two application, as well as in the interim final rule that I referred to earlier. So, so for example, let's say you're a new entity that started in Q1 2020, didn't have operations in 2019. So in that situation, you'd have the ability to compare Q2, 3, or 4 to your gross receipts in Q1 and determine whether you had a 25% reduction. Remembering that in order to qualify to begin with, you had to be in operation as of February 15th, 2020. So that's how this test works. You know, the next piece of this has to do with the definition of gross receipts. And to try to keep it as simple as I can, it's gross receipts or gross revenue. So, you know, whether you're looking at sort of the top line of your, you know, 1120, Form 1120 or 990 on your tax form, it's your gross receipts or gross revenue. There's been some question around, you know, accrual versus cash. And you can see on this slide, it provides some flexibility. It says in accordance with the entity's accounting method, we are hearing that, you know, that would be, you know, accrued or cash, depending on what method you were applying from a tax perspective. Now, if you have GAAP prepared, you know, quarterly financial statements that you feel, you know, comfortable with, and they're not much, you know, much different than what you would that you would disclose on your tax returns, could you use those? And that's something that, you know, see, hey, there could be certainly reasonable support there, but it would be something that you would want to consult with, you know, your lender on to make sure that that's acceptable. Ali, anything you'd like to add around gross receipts?
Yeah, I think just a point of clarification, because we got a question on this on so the annual versus the quarterly, you have to only meet it quarter over quarter. And if you do that, then you're eligible. The fact that you don't meet it on an annual basis becomes no longer relevant, right? The annual basis was just more simple. If you meet it on an annual basis, you don't have to go quarter for quarter. But the real rule is, as long as you're down one quarter, 25%, you're eligible. You don't go beyond that. And yeah, I know we got a lot of questions about net sales, or the fact that, hey, can we use net income? We can show that we're down year over year. Or yeah, unfortunately, the timing of certain revenues hit in one month that, could have easily qualified us if it hit in another month. Unfortunately, this calculation is pretty mechanical. You have to be able to just prove that that you were down in one quarter 25%, and it's on gross receipts basis. They're not going to look at net income or how your business really was impacted from a bottom line perspective. And I know, and it's in the slide, that there was questions about forgiveness of PPP loans, whether those would count as gross receipts, and the answer is no. Those are excluded from being considered gross receipts. So you don't have to worry about counting your PPP1 that's been forgiven into gross receipts. And we'll walk through some documentation later on in the presentation about kind of what documentation you probably would need to support that. So, and the same, sorry, one more thing, is the same rules for affiliations that we mentioned for the employees do apply for gross receipts. So if you have multiple entities, regardless of whether they, are applying for PPP, if they are considered affiliates, you control them both. You have to count gross receipts on a global basis, so of those entities.
So Ali, maybe we just pause here. I see a couple of questions coming in on gross receipts. Maybe we can tackle some of these now.
Yeah.
So let me. What happens if you qualify for one quarter, but if you compare year to year and overall you are not down 25%, that make you ineligible? So I'll take that. I think this comes down to the mechanics, right? So you can look at either quarter to quarter or overall, right? So if you're down in one quarter and you meet the 25% threshold, then you qualify. And you can stop there. You don't need to look at the entire year.
Yep.
Just need to make sure you have support for that, which leads to one of the questions down below. And we will get into the documentation requirements in a couple of slides, so perhaps we can address that documentation question in the following slides. But yes, you do need to have documentation to support this gross receipts. The size of the loan will determine when you need to submit it, but the type of information that they're looking for is tax information. I mentioned, if you have GAAP prepared financial statements, that's a conversation that you should have with your lender if that's appropriate. But the rule lays out tax information as support. See anything else here on gross receipts? That really seems to rule out those businesses that had large expansion Q4 2019 to 2020, and therefore sales jumped, but expenses did as well. I would agree with that. That's
the unfortunate piece, is it's not looking at net income. I mean, you can have an expansion, or you can have that you're really hurting at the bottom line. But if your sale trends have been different and they don't show this decrease of 25%, then unfortunately that does make you ineligible for this loan. So
Yep.
there's a question about quarters, calendar versus fiscal, or all indications seem to suggest that those are calendar quarters is what you got to benchmark against. And yes, you don't have to wait for forgiveness. That's not a requirement to go for PPP2. You just have to be able to prove that you have been able to spend all of the first round before that. So if you have an application for forgiveness that's been submitted but not granted, that's good. If you don't, then maybe you can mock up one, or just at least show that, hey, this is what I tend to apply in case they ask you for that. But that is the requirement. To actually receive forgiveness is not a requirement. So
Yep, agreed. And then we have a question here. Does the reduction in gross receipts apply to first-time borrowers also, or is it for second draw only? It's for the second draw only. And remember, in order to go for a first draw, you have to have in order to go for a second draw, you have to have a first draw, and you have to have used the funds.
as far as proving that you've exhausted the funds for PPP1, like I recommend, you're going to have to go for forgiveness for PPP1, most likely, if you haven't done so already. So maybe just a mocked up forgiveness application, with the support of what it would look like to go in for forgiveness, should be able to support, or, payroll reports, for example. The categories. We're going to go through in detail what you can spend it on. And what your covered period was for PPP1. So if you give the documentation that supports that, hey, here's what I've used the money on during that covered period, that should be sufficient to be able to prove it. So
yep. What do affiliate rules mean? And take this, and then we can move on, because it looks like some of these other questions we'll tackle in some of the later slides. So the affiliate rules have not changed from PPP1. The concept, there are SBA rules specifically around that. So for example, common control entities, right? That would be a situation where you have an affiliate, in which case what we're saying here on this slide is that, if you have an entity that meets the definition of affiliate, you need to bring in those gross receipts into the calculation as well. So it's not just your entity. You have to bring in, your affiliate's gross receipts as well, with third parties. So there is also a rule that says, if you have intercompany, transactions between affiliates, those would be eliminated and would not, count towards your gross receipts here.
Yep. All right.
Okay.
So we're going to go into a little bit of the other, items that have slightly changed. Covered period. As you recall, covered period for PPP1 originally was 8 weeks. Then the Flexibility Act was passed and switched that to 24 weeks. And there was essentially language in the rules that said that you could apply anytime during the cover, even before the end of your covered period, right? So PPP2 cemented that definition by saying that your covered period for PPP2, or for those who are now going for PPP1 for the first time, is at the election of the borrower, a period that's no less than 8 weeks and no more than 24 weeks. So you can choose anything between 8 and 24. There's no formal election that you need to make. You don't have to pick that at the front end. It's really when you decide to go for forgiveness and you feel like you've achieved 100% of the forgiveness. If that's week 16, you can use week 16 and you just notate that on your forgiveness application. Then there's nothing that you need to do on the front end to get this. So now your covered period is, again, not less than 8, no more than 24. Anything in between is acceptable. The calculation of the PPP1 and PPP2. PPP1 was 2.5 times your average monthly payroll. At the time, you had the option to use 2019 or the trailing 12 months payroll at the time, whichever you thought was more advantageous. Most people use 2019, and your maximum loan amount was $10 million. For PPP round 2, the calculation is pretty much still the same. It is 2.5 times average monthly payroll cost, which is the same definition as it was once. As a refresher, that's compensation for employees up to a maximum of $100,000. And essentially it's health insurance, state unemployment taxes, and retirement matches, right? So you were going to get the monthly average of that for a particular period times 2.5. But the key distinction here is companies who have an NAICS code that starts with 72, which is mainly the hospitality industry, restaurants, hotels, that type of stuff, have been afforded a 3.5 time multiple rather than a 2.5 time multiple. And now the maximum loan amount that you can obtain is $2 million. So that's how you'd calculate your maximum loan amount. So in essence, if you're using the 2019, let's say you're a company, you're not in the hospitality industry, you're using 2019, that's what you use for PPP1. PPP2 amount would be exactly the same money that you got for PPP1, essentially. So you're just getting really the same amount again. But if you feel that, for example, 2020's wages for some reason were higher, and that would give you a better result, you can also leverage that. You don't have to use the same data that you used for 2019, but there's a simplicity to using 2019 data that we're going to cover in detail when we get to the documentation piece of the equation. So let's just make sure that there is, I think we're good on questions here. So what can we use PPP money for? Originally, PPP1, you had to use it for payroll costs. And then there was a non-payroll cost bucket, which included rent, mortgage interest, interest on other indebtedness, which it was not forgivable. So you could use the money to pay that interest, like a line of credit interest, but you could not actually claim it for forgiveness, and utilities. And you had to use at least 60% of your proceeds on payroll in order for you to qualify for 100% forgiveness. PPP2 essentially came in and added 4 more categories to the existing categories. Those are property damage cost, operations expenditures, supplier costs, and worker protection expenditures. So more things that you can use it on. However, the 60% cap is still there. So you have to at least use 60% of the funds on payroll if you want to be eligible for 100% forgiveness. So we're going to go through some of the key definitions here. Just top line, the slides will be made available for everybody so that you can have the detail of the definitions. But essentially, your covered operation expenditures, this is mainly related to software like ERP or accounting software that would help you run your business. The covered property damages that related to damages due to public disturbance that is not reimbursed by insurance. So if you have not received or were not covered by insurance for those type of things, now you can, any cost that you use to repair or do anything like that, you can use that, and those costs would be forgivable. So again, those buckets are all what goes into your forgivable pool of costs. Covered supplier costs, those are costs that are buying goods that are essential for your business. It seems to be strictly related to goods and not services. So they have to be essential for the operator, and they have to be made pursuant to a contract that was in place before the end of your cover period or a PO for that matter. And the last piece is discovered worker protection expenditures. This is for the type of modifications essentially that were made as a result of COVID. And this talks about operating expenses as well as capital expenditures. So they give a lot of examples, for example, where they talk about if you had to put a drive-through window into your facility because now that's how you're taking care of business, for example, right? So certain things that relate to ventilation systems that you might have had to do to make the work environment safer. So those type of costs that you might have spent on that, or like PPE, material and supplies, are now qualified to be included as allowable PPP costs that would be eligible for forgiveness.
Okay, so maybe we just take a pause now, Ollie, and see if we can address a couple more questions. In calculating PPP2 salary expense, are there guidelines for the period to use for 2.5 months?
I think we've addressed.
Are we to use 8-week period, and can we use 2020? You want to take that? I believe you addressed that.
Yeah. So essentially, you can use it's the average monthly for trailing 12 or 2019. So now you can use either 2019 or 2020. Get an average monthly cost times 2.5. That's really what you can what you end up borrowing on.
Yeah. And, you know, and just an important clarification there too. So if you're going for a first draw now, right, that's one of the changes. So if you haven't gotten a PPP loan before, you can use 2020.
Correct.
And you actually have the option. You could use 2019 if you wanted. So let's see. It will be first draw applicants, but did not receive the 10K, but did receive, sorry, the EIDL grant. How should that be shown in our application? So we're going to talk about EIDL in a couple slides. That was actually a very favorable change as it relates to forgiveness. On the actual application itself, I don't believe the new application doesn't, you know, I could be wrong. Pull it up right now. I don't believe there's a spot for the advance. Is there, Ollie?
No. On the actual loan application, that's not the only thing that's referenced to EIDL is EIDL loans that were received prior to April 3rd of 2020 that required to be refinanced. But if you received your EIDL, which most people received it after that April 3rd date, those don't go anywhere on the loan application. It really relates to forgiveness, which we'll cover in a minute.
Right. It's an independent contractor. Income varies based on commissions. Do I look at commissions paid by quarter as gross receipts to match year over year? I'll take that one. You have the option to look at quarter over quarter or for the entire year.
Yep. But yeah, those gross commissions I think are the right measurement for that particular situation. Yep.
Yeah. Are we allowed to include subcontractor expenses in the calculation for the PPP loan? The answer is no. Contractor, if I interpret that question correctly, the rules have not changed around allowing independent contractors. Those would not be considered payroll costs for calculating the amount of your loan. Does affiliate include rental income reported in Schedule E, need to be aggregated with 100% owned sub, S Corp, and Schedule C?
Yes.
More yes. You got that one, Ollie?
If you own them all, then you need to aggregate them. However, if like the rental income is for a building that you own that rents to the subchapter S company that you own, because those are transactions in between the entities, they get eliminated. So it's as if you include it and then you take it out. But if it's a third party rental and that's an affiliate company, then you'll likely have to rope it in and measure those gross receipts.
Okay. What does operations expense and supplier cost mean in regard to the non-payroll forgivable expenses? Ollie, you want to take that?
Yeah, so the operation expenses, this is the software piece of it. So it talks about business software and cloud computing that relates to, any ERP type system that you're using. And the covered supplier cost is really any essential goods that you buy. Like, I have clients that have printing and anything that really you were buying as part of a PO that goes into your business, printing, buying paper. That is now essentially ineligible costs. So they're really trying to expand how much you can spend it. Just keep in mind that the maximum you can really spend without hurting your forgiveness is 40% of your PPP loan on these categories, and you need 60% on payroll to achieve 100% forgiveness.
And there is an opportunity, like we mentioned before, if you have not received forgiveness yet, and the amount that you plan to apply for is less than the maximum amount, to go back and include some of these covered expenses to maximize your forgiveness.
Yep.
So maybe just a couple more, and then we should move on. Is the PPP2 loan amount calculation based on 2019 payroll expense or 2020 payroll expense? That's an election. So you could use, either. Lobbying is a very small piece of our business. Does this preclude us entirely from applying as a first-time applicant? The answer is, I believe that depends, right, on the type of entity you are. If you're not-for-profit, there's specific guidelines, thresholds around the percentage of receipts that relate to lobbying, and that would disqualify you.
Yeah, I don't think
I don't have that.
But that one needs a little bit of research. But to your point, Mike, yes, I think there was a threshold that you had to exceed in terms of lobbying activity based on the nature of your business to properly be disqualified. So we can circle back on that one.
Yep. Okay, so let's continue. So there are certifications required, like round one. The point really here on this slide, you might recall in round one, there was a safe harbor that came out for loans beneath $2 million. There was a Q&A back in the summer or spring, I'm losing track of dates now, that basically said in order to be eligible, you had to meet certain liquidity type requirements, right? To support that you needed the loan. And, the guidelines came out and basically, provided a safe harbor for loans below $2 million. Now, what we've seen since, and perhaps some of you who have had larger loans, so as part of their sort of review and audit process, there have been questionnaires for all loans that have gone out above $2 million. So, basically to support this assertion. So now in PPP2, the loan amount is $2 million, right? So that's why it's unclear how that safe harbor would apply. But what the message really is here around this is that regardless of your loan size, right, you need to have prepared some documentation to support this certification. Because although not required, as right now above $2 million, all those borrowers are required to respond to the SBA around the certification. Everyone's subject to audit, right? So and if the SBA comes in and selects you for review, you'll need to be able to support this. Now, there's judgment obviously involved here, and there's certain situations that will be obvious, and the level of documentation will be less. And there are others that might be close calls where it probably makes sense to have a memo somewhere in your file to support in case the SBA comes in. But this is the same certification from round one. It's been carried over to round two. So there is going to be a simplified application for forgiveness. Now, simplified doesn't mean automatic. Okay, so you might recall in round one, there was a similar simplified application for loans under $50,000. So this is nice. They've extended it to 150,000, right? And basically what this means is upon forgiveness, you know, you'll need to make certifications, but you won't need to, you know, provide, call it the extensive level of documentation that you might otherwise. Now, with that said, you still have to have the documentation, and you'll see on this slide some of those documentation requirements, retention requirements. But stay tuned. The application hasn't been issued yet. It should be any day now, and we're expecting some additional guidance from the SBA around the forgiveness process as well. Ali, anything you want to add here?
Yeah, I think I would just emphasize that, yeah, this is not automatic. Essentially, the same exact calculations for forgiveness still apply. It's just that, you know, they're just making you certify and maybe submit less documentations to your lenders. But it doesn't mean that if you didn't spend the money on the right things, or you had, you know, reductions and all that, that you now automatically qualify for 150 grand of forgiveness. All right, so we're going to go through some just general other provisions that came in that clarified certain things. Benefits, again, benefits were part of your payroll cost definition. So, you know, first it was just health insurance. Now they've clarified that you can include group life, disability, vision, or dental insurance as well as the original health. You know, we've always felt that dental and vision should be included and did so, but group life, disability, that's an added one essentially. Safe harbors, the exemption based on employee availability, those are the safe harbors that were in place on the forgiveness that, hey, if you could at least bring back your people to the same level that you had them on February 15th, 2020 by December 31st, 2020, you do not have to worry about those reductions that came into the calculation of forgiveness. You know, that's now since been extended for PPP2s and PPP1s till the end of the covered period. So the new draws on PPP1s. So, but for the original ones that have been issued, essentially those are still the December 31st. So if somebody has a PPP1, they haven't gone for forgiveness, you still had to December 31st. But anybody that's going in for a round right now or getting a PPP2, those exemptions have shifted for those particular ones, essentially. Forgiveness amount, this was huge, is not taxable, obviously, for the first law, but the IRS had issued guidance that said, well, the deductions or the wages and the other expenses that you paid for using PPP money, we are not going to allow you to take a deduction for them. This was a big contentious point. They have since clarified that and essentially confirmed that the amount of PPP forgiveness is not taxable, and the IRS does not have the right to deny deductions. So you pretty much don't get to be taxed on the income, and you get to keep all of your deductions for the wages and other expenses that you paid using PPP funds. Talked about the ability to get more money if you didn't apply the right way the first time. Finally have a definition of seasonal employers. You know, we've talked about that seasonal employers can now also go get an increase if they feel that they qualify using this definition. So it's somebody who operates for no more than 7 months in a year and earns no more than a third of its receipt in any 6 months period. And if you fit as a seasonal employer, now you could use any 12 weeks to calculate your payroll and get an average monthly that you can apply the 2.5 times to between Feb 15, 2019 and February 15, 2020. They have to be a consecutive 12-week period, so you can use essentially your high season, try to maximize that loan.
Yeah, so I'll eat quickly. So that is one of the examples. If you're a seasonal employer and the amount that you calculated under this new methodology results in a higher loan amount than what you initially went for, you can go back and apply for an additional amount.
Yep. The loan applications that have been released, 2483 SD for the second draw. I know there was a question on idle grants. So idle grants, originally, they would have reduced your forgiveness amount for PPP. So if somebody got a $100,000 PPP loan and a $10,000 idle grant, they would have been only eligible for a $90,000 forgiveness on the PPP side and a $10,000 grant forgiveness. So they would have been short that $10,000. That's no longer the case. Now you can get 100% forgiveness on PPP, as well as a $10,000 grant, idle grant forgiveness completely. Those who applied for forgiveness and had that situation, the SBA is saying that those are going to be automatically taken care of. So there's nothing that needs to be done. They should be, the SBA will update all of its database that you don't owe anything pretty much. And now if somebody did not apply for an idle loan and feels that they qualify, they can do so until December 31st, 2021. It originally had expired at December 31st, 2020.
Yeah. So before we move on, I mean, those are two significant points, one on the idle and then the one on the prior slide around the deductibility of expenses. Those are big changes that are very helpful, nice changes. And we've been getting a lot of questions along the way, particularly on the deductibility of expenses. So the question has been answered. So that's good news from a tax perspective. And the same applies for idle expenses, by the way. So, expenses, supporting your idle loan are also deductible for tax purposes.
Yep. And yeah, so the idle grant is still available. The SBA has 21 days to approve it now once they reopen things up. But if you've already applied for an idle grant and you've received it, you're not going to get a second idle grant. But for those who have not gone in for it, they can do that. The change on the deduction is retroactive. Yes. So essentially all of that's it. It's for 2020. All deductions remain. PPP is not taxable. Just gonna take a minute to talk a little bit about forgiveness. I know there's a couple of questions that came through. For example, somebody asked if they only spent a third of their payroll cost on, can they go in for partial forgiveness? Yes, you can. So the forgiveness application, you gotta use, you gotta show how much you spent on payroll as well as other costs. Remember, you qualify now for all those other categories. So you gotta pool those together. And then go through the forgiveness application. And if it results in a partial forgiveness, you can submit it with the partial forgiveness, and they would hopefully grant you that, and the balance of your loan becomes a loan that you would pay over, depending on when you applied, could be 2 years or 5 years at 1%. So you can do that. If you're a seasonal employer or any other type of employer, you can go for your forgiveness application the same way. You just got to gather the information of how much you spent during your covered period on eligible costs for PPP, and go through the math in order for you to see what you qualify for, and then you should be able to submit that application essentially.
Yep. There's a question here on cloud computing. So that would, and whether cloud computing is now a forgivable expense. And,
yeah, I mean, as long as it fits in the definition of, here's the exact definition, right? So it's a cloud computing services that facilitate the business operations, product and services. So those would be your, so you're not really buying a license. It's not on a desktop, right? I have QuickBooks Online, for example. That's a cloud computing software. Because I don't have a license, it's only hosted on the web. And, it fits in tracking payroll and expenses and human resources, sales and billing functions. So now the fee that you pay during the covered period only would qualify to be included as a forgivable cost. Essentially, that's how that would work.
Yeah. Yep. Agreed. Yep. And let's see. Does an applicant have to apply for round 2 of PPP at the same lending institution where they applied for PPP1? The answer, that's a nice lead into our next slide. The answer to that is no. But we can talk about some of the documentation requirements and some of the simplifications that have been made to those.
Yeah, so that's a very good point, because while you don't have to go through the same lending institution, there's no requirement to do so. it's going to be much easier to go through your same lending institution. So the rules as they're written is they're saying that, hey, if you are going back for round 2 to the same lender and you're using the same underlying payroll information that you used in round 1. So let's take 2 companies. In round 1, they used the 2019 average monthly payroll. They're going to use the same now for PPP2 going through the same bank. They're saying you no longer have to resubmit your application with all that documentation, because the bank should have it. They've approved. It's going to be exactly the same amount as the first round. They've already approved the first round. All you have to do is prove that your revenue went down 25% to them, and they should pretty much approve and move your application through. And so as a result, it's much more simplified if you use the same lending institution, but it is not a requirement. Should be able to use any lending institution if you feel that that works better for you. In terms of documentation, other than potentially the payroll stuff that you need to support if you don't use the same lending institution, or if you change your methodology, if you were applying using 2019 for round 1, now you want to use 2020, you have to resubmit the payroll information. For loans who are 150 or more, you have to also provide documentation supporting the revenue reduction. Those could be in the forms of tax returns or internal financial statements that would show that. They even give you the option to provide bank statements. I don't know how that's going to work, because not everything that runs through as a deposit and a bank statement is necessarily a gross receipt. But maybe for simple small borrowers that are just cash basis, that might be the case. But you got to be mindful about that, because especially if you provide 2020 bank statements where there was a PPP loan that came through or an idle loan that came through, you don't want that to be counted as gross receipts just because it's a deposit into the bank. So, but loans who are under 150 technically don't even have to provide the banks on the front end any proof of reduction of revenue. You have to fill the application and it asks for your quarterly revenues, but you don't even have to provide support. However, you will eventually have to provide that support when you go in for forgiveness or when the SBA asks for it. So for those, our recommendation is you're doing the work anyways, you might as well provide it on the front end, because you have to put it on the application itself. You have to calculate. It's not like you don't have to calculate it. So you might as well give them the support of how you got to those numbers and not wait. And here's a couple of resources between the SBA and the Treasury that also have a lot of good information, or copies of the applications if somebody doesn't have access for them, that could be leveraged. So we're going to run through this very quickly so we can just leave also some time to go into more questions that have come through. But we did want to, these are some key changes that happened with the act that could benefit clients. ERC, short for Employee Retention Credit. Just a quick overview. These were credits for employers who retained their employees, essentially. The credit was 50% of the first $10,000 of wages. So it's essentially up to a $5,000 credit per employee that you have. And essentially it was available on for entities who either were fully shut down or partially shut down during a particular quarter, or experienced a significant reduction in revenue. That was 50% sales year over year that were down in a particular quarter. What the key change is, this was not available for anybody who got PPP. So a lot of companies got excluded from being able to use that. They've since essentially amended the law to say, no, companies who receive PPP can actually also receive this credit. But what you cannot do is you cannot use the wages that you've paid for using PPP money and that you're getting forgiveness on in order to compute this credit. However, we're seeing a lot of clients that were essentially in Q2 might have been down 50% that now are eligible to use this credit for wages that are not part of PPP eligibility. And the beautiful thing about this credit is the moment you're down one quarter 50%, you can use the quarter that's right after it. And you can keep using quarters until the quarter that follows the one that exceeds 80%. So all you need is one quarter to go down, and it might qualify the remainder of the year for you if you haven't recovered well. So just something to keep in mind, because this could be substantial for companies. So that's why we wanted to highlight it. It's a pretty mechanical and detailed credit, but just keep in mind, in 2021, it's since changed. Now,
Hey, Ali, quickly too, just to highlight, the decision too is important, around ERC and the PPP, because they're both, wage based, so you can't double dip.
correct.
So, for example, if you can't use the same wages to apply for your, credit here as you do for forgiveness. So, it's a planning strategy, but you should make sure you have enough, payroll to be able to, cover each, or, what mix do you think is most beneficial?
Yep, absolutely. So as far as the 2021 changes, they've made it even easier to achieve this. Now, all you have to do is prove that your revenues have gone 20% down, not 50% quarter over quarter. And you're still now measuring 2021 quarters all the way back to 2019. So they're essentially saying, hey, 2020 is a lost year. Go back and measure against 2019. And now the credit is 70% of the first 10,000. So that's $7,000 per employee. So again, a lot of very good potential money that's out there to just keep at the top of your mind, that you can now benefit from this with PPP, but obviously detailed analysis have to be done. And lastly, we wanted to make sure that you're aware of the Shuttered Venue Operator Grant. This is a grant that's eligible for entities who are like live venue operators, theatrical producers, live performing arts organizations, museums, motion theaters, or talent representatives who prove that they also had a reduction of 25% in gross receipts, very similar to the PPP type. But the reason why we're highlighting this is this grant is going to be much more lucrative than potentially a PPP loan for those who fit this criteria. And you cannot get this grant if you got a PPP. So before you go in and apply for your PPP, make sure you've seen if you fit within these definitions, and if essentially you can leverage this grant. And the reason I say this is better than PPP is because of how it's calculated. Essentially, the way it's calculated is it's 45% of your gross earned revenue for the year 2019, right? So as you can see, PPP is 2.5 times average monthly payroll. This is 45% of your revenue. So you'd hope that, almost 50% of your revenue is better than 2.5 times of your payroll. Also, the maximum on this is 10 million versus 2 million for PPP round 2. And you have a ability to go in for a second draw on this, which is equal to the 50% of the first draw. So now if you think about it, you almost have about 70% of your revenue advanced to you. And you can use it on a lot more costs than what PPP limits you to use it for forgiveness. And it doesn't have those, reductions on FTEs and limitations and so on and so forth. So from that perspective, this is a much, much more robust program potentially than PPP2 if you fit the criteria. Unfortunately, the SBA, so this will be administered via the SBA, not through lenders, similar to how the EIDL loan is done directly through the SBA. We're waiting on, how the SBA is going to really launch this. So it's not really yet available, but something to consider, because I know there's an urge to go in for PPP, but if you can hold off and you feel that this fits, this might be a better option for you. So
thanks. So Ali, things are moving pretty fluidly here. So you have 3 key programs where they're either new or there's been changes, right? Actually 4 if you want to bring in EIDL as well. So I think the message is right now with the PPP beginning to open to everyone next week, like I mentioned, is really to be in close contact with your lenders, with your advisors around what the best path is for you here. Mentioned, there could be opportunities, for the employee retention credit, for the new grant that could, sway in whether you go for a PPP or not. And also just to clarify on the Shuttered grant, if you already received the PPP, and Ollie, correct me if I'm wrong here, you applied before the new law, you could apply for the grant.
Correct.
It's just for any new loans basically in the new year, beginning, now or next week when you, if you decide to do that. So, weigh your options and we hope that this has been helpful. I know we had until 10:15. Ollie and I are open to stick around until 10:30 to try to address some additional questions. And as you can see here, both Ollie and I we're part of UHY's National Crisis Management Services team, which has been spending a lot of time, as you can imagine, over the last year and a half, helping companies, entities, organizations like you all through these challenging times. So after this call today, please feel free to reach out to Ali or I or any of our friends and colleagues at UHY. We're here to help.
Absolutely.
Michael and Ali, thank you both for taking the time to share these updates with us. Thanks to everyone that participated this morning. Please keep an eye out for the materials. We'll be sending a recording of this morning and also the slides. It is almost 10:15, so we understand if people have to leave, but we will stay and answer a few more questions until 10:30, if that's okay with you, Michael and Ali.
Sure.
Okay, great.
Yeah, so we can, let me see here. We can take some questions.
Yeah, there's still a few being submitted into the chat.
Yep.
So
let's see which ones we didn't address.
Let's see where we left off.
Can you include owner's draw that are in lieu of salary? In terms of the definition of payroll costs, no, owner draws do not count. But it depends on your structure. Like if you're a sole proprietor, you can use your self-employment income, and that would be a replacement of income. There's a question about partnerships and guaranteed payments. Yes, those count. So for partnership, it's really based on self-employment income for general partners. That is how, and then payroll costs, obviously for other employees. That is how payroll cost is defined for those particular entities. And for like sole proprietors or general partners, the forgiveness is almost automatic. You don't have to prove that you're spending it because they're deeming it to be replacement of income. So, owner's payroll is not excluded from monthly payroll calculations, but you're capped like the other caps. So you can only include up to $100,000 on an annual basis for an owner. The cap for forgiveness on owner compensation is different than the cap for forgiveness on regular employees. That cap is $20,833 compared to $46,154 for general employees. So,
and similarly to that one, Ali, on partnerships, the guidelines change a little bit around partnerships as well, where you would file your application for the partnership, but you can actually include the GP's compensation as part of the payroll.
Yep.
So that is a change to those out there who may have applied the first time around and seek an additional loan this time around.
Yep.
Calculating monthly payroll for a partnership.
We talked about that one.
Yep.
Owner payroll.
Payroll excluded. Water. We're not allowed to open. What if we're a seasonal employer of a water park and we're not allowed to open in 2020 due to CDC rules? how do we apply for forgiveness of PPP1? And are we eligible for PPP2? So the rules around this are you can apply as long as you weren't you haven't permanently closed, right? And if you didn't apply the first time around, you would, fill out the new loan application for PPP1 based on the rules for your particular situation as a seasonal employer. So the first step would be in that situation to consult with your professional advisor and to find a lender, right? That can help you through that process. Ollie,
Yeah.
anything you want to add on that one?
And I think the question for PPP1, if it's related to forgiveness and you were fully shut down. So if you're saying, hey, I didn't spend my money on payroll, you can, essentially you can try to apply for forgiveness. So if you have zero spent on payroll, you're not likely that you're going to get anything forgiven, and it might just convert into a loan, which you could have the terms be probably 5 years at 1% interest. And given that you were shut down for 2020, the likelihood is you can easily meet the 25% reduction. And as a result, you should be able to get PPP2 as long as, yes, you're not essentially permanently closed. You're simply just, hey, I'm keeping up, just waiting for the orders to be lifted so I can open the park again. So that's how that one would work.
Mm-hmm.
I think we've answered the next two, Michael. So PPP, I think you mentioned that today was open for banks that are less than $1 billion, and then about Tuesday, I think most other banks are going to be open to start taking applications.
Correct. Tuesday, all institutions with assets greater than billion.
Yep. Okay.
I received a loan from SBA and did not file one from my firm. Not file one. Do I put a second for the 501c3 and for my firm? For this one, I think we need some more facts. So let's take this one offline. Feel free to reach out to Ollie or I afterwards so we can just make sure we understand the context before answering. Next one. The owner of an LLC that has always taken a salary in the form of a drawing, do these draws count in payroll calculation or any other part of the calculation? I believe you just addressed that.
Yep. Yeah, I think that one and like the second one are similar a little bit. Yeah, for owners who are single member LLCs, you're using your 2019 or 2020 Schedule C income, right? So if in 2019 you show a loss, for example, you're not eligible to get anything. They're calculating it based on your 2019 income, and they're providing you, if you didn't have any other employees, obviously, they're providing you replacement of income, which is calculated at the average of your 2019 earnings. So 2019 earnings divided by 12 times 2.5. That's what you're getting as replacement of income. You don't have to count your draws or what you took from the bank or anything like that. That's how you calculate it, and that's ultimately it's going to be automatically almost forgiven for that same amount. If you have employees, you have to count your employees the normal way you would do for any other business.
Yep. So there are a few other questions here I see on owner draws. So we have not addressed your question. Please reach out to us after this this webinar. Are religious organizations eligible for PPP?
Yes.
The answer is yes. And again, the eligibility requirements. I mean, if you look, for example, not-for-profits, 501c3s. But the answer, the 501c3s, and now it has been expanded to 6s as well. But the answer to that is yes. Are two independent, completely unrelated LLC businesses owned by the same members considered to be affiliated?
So
Go ahead.
the affiliation rules for SBA are fluid. They really look at control. You know, they don't just look at relationships of businesses or stuff like that. They're really looking, can you influence the both companies? If they're owned by the same people and both people exercise control, the likelihood of the answer is yes.
Yeah. And again, that doesn't mean you can't apply for a loan for a particular entity. What this does mean is you have to consider your affiliate in the headcount rules, right? The size rules, 300 employees for, you know, round 2, 500 for round 1. And in the gross receipts calculation that we talked about before, 25% rule would need to bring in all those third-party receipts from your affiliate. What if a venue got PPP1 but chooses not to have it forgiven? Will they be allowed to apply for the shuttered venue grant? And the answer is yes, assuming that you applied for PPP1 before the year. So in other words, not as part of this next tranche, but you applied for it in 2020. Ali, do you agree with that?
Yep.
Do we have to provide payroll documentation if we apply to the same lender and ask for a smaller amount that we requested in PPP1? Can we take advantage of the simplified application process? My answer to that is yes, I think you can if it's less. But consult with your lender, make sure that they're comfortable with that. I think that's again, back to the rules that are required, and you also have to be using the same payroll year. So 2019, for example. So if you're using the same, you know, payroll support, but you just want less, then I think you're okay. Ali? You
Yes, and the question about simplified application, just to clarify, the 150 simplified application is for forgiveness, not for application. So can
right. Yeah, that's a good point. I missed that for the forgiveness element there.
Can event planners that receive PPP in round 1 apply for the new SBA grant in round 2? So if you fit for the shuttered venue grant, then yes, you can apply for it. The first PPP that you've received prior to the date of the enactment of the act, which was December 27th, does not hinder you from getting that shuttered venue one. But what you cannot do is you can't go for PPP round 2 and essentially get the shuttered venue.
If we apply for both PPP1 and PPP round 2 loans, are we also able to apply for CARES Act SBA loan payment forgiveness? So just to, let's try to interpret, if I can interpret that question the best I can, and I'll chime in here. So I think the short answer is yes, but in order to apply for round 2, you have to apply for round 1, or you've had to not only apply, you've had to use the funds for PPP1. You don't need to have had received forgiveness in order to go to the next step.
Right. And I don't know if the reference here is for, if you're referring to the the subsidy that the SBA is doing by making payments on behalf of SBA borrowers on other SBA loans, like the 6-month payment that the SBA is providing, if that's the question, that is automatic. That is not something that you have to apply for if that's what you're referring to as SBA loan payment forgiveness. So to Michael's point, you don't need to be forgiven on PPP1 to go for PPP2. And if we're talking about just the relief of payments on other 7A loans that was provided for by the SBA the first go round, and now has been extended for another 3 months, I believe that would be automatic.
Great. For the owner of an LLC that has always taken a salary in the form of a drawing, do these draws count in the payroll calculation or any other part of the calculation? Do we
I think
address that?
Yeah, we've addressed that.
Can you apply for both PPP and the grant and then decline the one that makes less financial sense? I believe the answer to that is no, because you'd be required to certify under the PPP application that you have not taken out a grant.
Yeah, so it's going to come down to that certification really, and what the grant certificate. Like if they say, hey, did you apply for one? Then the answer will be no. If they say, did you receive one and you've declined it, then you really probably technically didn't receive it. But it's always not advisable to just go for two things that would contradict with one another.
What were the forgiveness safe harbors and reference periods with respect to maintaining FTEs? Do you want to take that one, Ali? I mean, our thinking is that it's going to be extended to the end of the covered period, right? We're waiting on clarification from the SBA on that. So everything extends out, but the original dates, the sort of benchmark dates that you would apply would not change. So it
remain the same.
Gives you more time to bring people back. Ollie, any?
Yeah, no, that's right on. The original reference periods remain the same. So the forgiveness piece didn't really change much. But yes, now like your ability, the date that was December 31st to bring back the employees, if you go for PPP round 2, for example, well, now that date is going to go all the way down to the end of your covered period of PPP 2, right? So that's how it should work.
Did you ever speak to why using 2.5 multiple 2019 might be better than using 2.5 monthly payroll? We didn't specifically address that, but it's a good point, and it's a planning strategy. If you think 2020 results in a better loan or more loan to you, then that could be an option. But keep in mind the certification we talked about earlier as well, right? So that would suggest that you've got trending. You're bringing in people. You're doing better in 2020 than 2019. Although that's just at the surface. There's a lot of other factors there that you would just need to think about before taking that approach. Is what I'm saying. But yeah, I mean, it could be beneficial to use 2020 instead of 2019. So that's a consideration that you should have. And Ali, anything?
Yeah, one thing that I would just encourage people to do is don't solely focus on forgiveness. I know a lot of people are in survival mode. This money is very critical. The loan terms are 5 years, 1% interest. This is truly the cheapest money you're ever probably going to be able to borrow. They're not guaranteed. They're not collateralized. So if you get the money and you feel like I'm not going to get full forgiveness and it's going to become a loan that I have to pay back, it might not be a bad answer if it means that the business using that fund makes it to the other end, right? So while you want to maximize forgiveness, of course, I think the downside of not getting full forgiveness is not that bad given the terms of the loans that you're gonna maintain, right? So keep that in mind. I know there's questions about contact information. We'll make sure that they're gonna be on the slides when we share the deck, so that way you can email us and reach out to us so we can make sure that that everybody has them.
Ali, Michael, thank you so much. It's now 10:30, so we're going to end today's session. And like you just mentioned, the slides, the recording, and all your contact information will be provided to everyone later today. So take care, everyone, and stay safe and enjoy the rest of your day.
Thank you, everyone.
Thanks, Jennifer. Thanks, Ali. Stay safe, everyone.
Bye-bye.
Thank you.